Hello, everybody, and welcome back to Open Interest. I'm Mike Coe. Bit of a whipsaw today. The S&P dropped nearly 1.7% from Friday's already very weak close at the lows today, only to recover 2.26% to finish the day higher. The VIX exceeded 30 for much of the session, but fell as the market bounced and ultimately finished the day at 27. The U.S. listed options market traded nearly 43 million contracts. That's well above average, so there were many large trades. I've decided to focus on just three of these. The first, HACK. This is the ETF MG Prime Cybersecurity ETF, quite a mouthful. Many of the constituent stocks within the fund have yet to report, and those include Akamai, Palo Alto Networks, VeriSign, Cisco, Cloudflare, Fortinet, Checkpoint, F5, and Juniper, just to name a few of them. Those upcoming earnings could be one of the reasons we saw a large purchase of the May 52 puts. Over 4,500 of those traded for about $1.10 a contract. The ETF, which had been under significant pressure prior to Russia's invasion of Ukraine, down over 23% from December 2021 to the day of the invasion, bounced 15% through the first week of this month on concerns of Russian cyber attacks. However, since then, HACK has given back much of those gains, and it seems at least one options trader may be speculating it will drop to or maybe even through the levels of late 2020. It's worth noting that HACK remains 22% above the pre-pandemic peak, and much of the gains that we've seen in this basket of stocks over the past few years comes mostly from multiple expansion rather than actual earnings growth. And those multiples were already very lofty for the group overall. This has not been a healthy market for high-flying and high-valuation stocks. It could be that this is just a trade targeting another one in the space. Another interesting trade was in GDX, the gold miner ETF. A large December 60-70 call spread traded. Ultimately, over 40,000 of both contracts traded. Goldman Sachs reiterated a bullish call, and in a note they said, the combination of strong investment demand, accelerating central bank purchases, and resilient consumer demand means that a much higher gold price is needed to keep physical gold markets balanced. Moreover, underlying bullish drivers of each of these three categories are set to remain for the rest of the year, meaning that the bullish gold price trend is set to continue. We therefore reiterate our year-end target of $2,500, meaning $2,500 an ounce. Okay, so a couple quick points. First, generally, rising interest rates would be expected to strengthen the dollar, and a strengthening dollar, all else equal, is anti-correlated to gold. That said, we are coming off record low rates. Even if the numbers we just saw in inflation rates are now peaking, overall the inflation will likely remain elevated, and wage inflation is real. That, along with the other factors cited by Goldman, are bullish for the metal. Now, GDX actually closed down over 3.4% today, and that 60-70 call spread is way out of the money. But here's the thing. Miners are correlated to the metal but tend to exhibit leverage to it. Over the past 5 years, the miners have a beta of about 1.6 relative to gold. So if one agreed with Goldman's price target, which is more than 30% higher than today's closing price for gold, then there's a case to be made that GDX could be maybe 50% higher by the end of the year. And using a little arithmetic, that still only gets us to about $53.50. But during the 1970s, gold hockey sticked. So it's possible that the trader who bought these spreads is anticipating a spike even more pronounced than the $2,500 forecast. But it's also possible that a trade like this call spread could return very nice profits even if GDX doesn't rally through that lower strike. If GDX simply rallied to the mid-50s within the next few months, a level that's certainly reasonable if gold sees a move to 2,500, as long as there's some time remaining until expiration, that call spread could be worth a great deal more than it is today. So that's basically because GDX will have rallied, and we're likely to also see sharp increases in volatility in the metal and maybe in the miners themselves. So choosing a spread this far out of the money could simply be an effort to get some additional leverage out of the trade. Finally, we saw one of the larger single stock trades, at least in contract quantity terms, that you're likely going to see. A trader purchased 100,000 of the May 14.5, 15.5, 1x2 call spreads in PBR, Petrobras, purchasing 100,000 of the May 14.5 calls and selling 200,000 of the May 15.5s. Now, this is a trade that is commonly referred to as a recovery play, and that's because sometimes traders will place a trade like this against a long stock position after that stock declines. And the purpose is to provide a little near upside juice or leverage to recover losses while anticipating upside resistance at the levels from which the stock fell. So in this case, 100,000, 14.5, 15.5 call spreads would be worth 10 million at 15.5. Of course, the profits fall off after that. You'd ultimately lose if it went well through that 16.5 level to the upside. But although PBR did get to and even exceeded 15.5 recently, it was there only very briefly, just 2 trading days. So is it possible that an unfortunate trader top-ticked it and is looking to recover losses from a 15.5 cost basis? Yeah, it's possible. It's also possible that a trader is eyeing the May 5th earnings and is assuming that the recent high will actually serve as resistance in any case and is willing to put this trade on uncovered. Either way, the trader spent $700,000 in premium on a trade that could be worth as much as $10 million at May expiration if PBR finishes at 15.5 on that Friday. That's almost 14% higher than today's closing stock price. Now, an upside move of that size through earnings over a comparable time frame in this stock is pretty rare. In fact, looking at the history, I saw only 5 instances over the past 44 reported quarters with a move greater than 14% to the upside from a week prior to earnings through the 3 weeks following. So that's roughly the same time window that we're looking at here. And one of the 5 was the 47% move that occurred around May 2020 earnings. And that was probably as much as anything a function of the pandemic rebound that was going on at that time. In any case, a large bet targeting 14% upside within the next 5 to 6 weeks. Chris Verrone of Strategas, he was on CNBC today, and he was suggesting that a steep pullback that we've been seeing in energy, that this thing may actually be overdone. So maybe just playing also for a bounce in that space. Like this content, let us know by hitting the like button. And please consider subscribing. Thanks for watching. If you liked the content, please consider subscribing to the Open Interest YouTube channel. That's youtube.com/open interest. And of course, you can also follow or tweet me at Michael_Co, or go to our website, www.openinterest.pro. Thanks for watching.